If you're new to investing in Canada, here's the first thing you need to hear. You do not need to be rich. You do not need thousands of dollars. And you definitely do not need to be some stock market genius. Most people delay investing because they think they need more money, more knowledge, or perfect timing. But the truth is simpler. The biggest mistake most Canadians make is waiting too long to start. Because investing is not about being perfect. It's about starting early, staying consistent, and understanding a few basic rules. So if you're sitting there thinking, where do I even begin? This information is specifically for you. No hype, no complicated jargon, just real beginner steps for Canadians. By the end of this, you'll know what investing actually is, where to start in Canada, what accounts matter most, and how to avoid beginner mistakes. Let's make this simple. First, what is investing? At its core, investing means putting your money into something that has the potential to grow over time. Instead of letting cash sit in a regular savings account, losing buying power to inflation, you're putting it to work. That could mean stocks, ETFs, mutual funds, bonds, GICs. Now that list can sound overwhelming, but for beginners, trying to learn everything at once is exactly why many people never begin. So here's the simpler version. ETF means exchange traded fund. Think of it like a basket. Instead of betting everything on one company, you buy one basket that can hold dozens, hundreds, or even thousands of investments. That means more diversification and usually less risk than trying to pick the next big stock. For many Canadians, this is one of the easiest entry points. Now, before you invest a single dollar, you need to understand where you're investing. Because in Canada, your account matters almost as much as your investment. The big one most beginners should understand first, TFSA, tax-free savings account. And despite the word savings, it can also be used for investing. A TFSA is not just a savings account at a bank. Why does this matter? Because growth inside your TFSA is tax-free. If your investments grow, you keep more of that money. For many Canadians starting out, this is one of the best places to begin. Then there's RRSP, Registered Retirement Savings Plan. This can also be powerful. But for many beginners, TFSA is often simpler first depending on income and goals. The point is, don't just buy investments randomly. Choose the right account. So, how do you actually start? Step 1. Choose a platform. This could be your bank's investing platform, a robo-advisor, or a self-directed brokerage. If you want simplicity, robo-advisors can help automate investing based on your goals. If you want more control, a self-directed account lets you choose your own investments. For total beginners, simple often beats complicated, because complicated plans people quit rarely outperform simple plans people stick to. Step 2. Start small. This is where people freeze. They think, I only have $50. I only have $100. That's not enough. That way of thinking is wrong. Starting small builds behavior, and behavior matters more than size in the beginning. Because someone investing $100 a month consistently often beats someone waiting years to invest larger amounts someday. Consistency builds momentum. Momentum builds habits. Habits build wealth. Step 3. Focus on consistency over timing. You will hear endless noise. Markets are crashing. Markets are booming. Wait for the dip. Now's the perfect time. For beginners, trying to perfectly time the market can become an excuse to do nothing. A common strategy is regular investing, weekly, bi-weekly, monthly. This approach can reduce emotional decision-making because emotion is expensive, panic selling, fear buying, chasing hype. Be aware, these are beginner traps. Now let's talk about one of the biggest mistakes, overcomplicating investing. You do not need 20 different stocks, daily trading, constant market watching, financial influencer hype. Many successful investors build wealth through boring consistency, simple diversified investments, long-term mindset, patience. Boring can be very powerful. Another beginner trap? Investing before building financial stability. If you have high-interest credit card debt, that may deserve attention first. If you have zero emergency buffer, building one can matter. Because investing works best when you're not constantly forced to pull money out in emergencies. Strong foundations matter. Now, how much could this really matter? Let's keep it simple. If you invest regularly over years, growth can compound. This is why starting earlier matters so much. Time can become one of your biggest advantages, not perfection. Time. So here's the beginner blueprint. Open the right account. Start small. Choose simple investments. Invest consistently. Avoid panic. Think long-term. That's it. Not flashy, but effective. If you're overwhelmed right now, good. That means you're learning. Just don't let overwhelm become inaction. Because the hardest part for most people is not becoming an expert. It's simply starting. And once you start, you can improve as you go. Your first goal is not to become a professional investor. Your first goal is to become someone who invests. Because identity changes behavior, and behavior changes outcomes. Now, because in Canada, you do not need thousands to begin. You just need a plan and the decision to finally start.